Welcome, everyone. I'm Angelo Robles to Angelo Robles' Effective Family Office podcast, where I look to distill the best practices and best ideas of the world's most successful families and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of the family office. Today, our podcast is titled CEO of a $50 billion multifamily office, Adapting During Crisis. It features Peter Mallouk, President and CEO of Creative Planning. Peter has built one of the largest MFOs, financial advisory firms in the world, let alone the United States. And I thought it would be really intriguing. And we've had Peter on before, going back the spring of 2019. But obviously, so much has changed. That feels like 100 years ago, though it's only been 15 or 16 months. So obviously, if you heard my open best practices, I think we all, as families, as enterprises, as advisors, as MFOs, as SFOs, would like to hear someone who's the CEO of a $50 billion managing in terms of $50 billion of net worth for amazing families across the United States and perhaps to some degree around the world, and adapting during crisis and perhaps getting stronger for it. So on that note, Peter Mallouk, welcome to the show.
Hey, it's good to be with you again, Angelo.
Always a pleasure. Well, let's kind of get right to it. I am assuming, no different for you, it's probably working remotely, and you have a pretty significant team. So when did this start to, you probably saw this coming sometime in late February into early March, and at least in our area, in the New York area, and maybe we were a little early, which has played to our benefit, things were kind of shut down. I believe the date was March 14th. I might be a little off. And just boom, New York went to kind of feeling like a ghost town. So for you, you saw this coming. How did you react and how did you adapt to today's times?
So our headquarters is in Kansas City. We've got 26 offices all over the country, Northeast to California, down to Florida. But our headquarters is Kansas City. And we sent everybody home, before the state got there. And Kansas City was actually pretty proactive. Kansas was the first state to send students home.
Wow.
In the country, I believe. But we had all our team working from home, ahead of the state and county orders. And it was pretty easy to move remotely. We've been wired for that and prepared for that, not for this specific event, but just for whatever was going to happen. And everyone kind of picked up their laptop and some people a printer and just went home, and everything just worked the next day like it was supposed to. So really moving remote was not a big deal. I'm not one of those people though that thinks, everyone's like, oh, yeah, everything's the same remotely. I think that's crazy. I think that there's two things. I think one, you're missing this kind of collaborative. There's so many things. If creative planning wouldn't be what it is today, if I didn't just randomly walking, bumping into people, having lunch with people, someone swinging my office and going, hey, do you think about this? And I'm me going, no, I didn't think about that. Or, wow, what if I hadn't bumped into you? And making a change. And yeah, you can say, well, let's have formalized calls. And that's very, very different than just the stuff that just comes about day to day. Hey, I just got out of a meeting and this happened. And what should we consider something differently? You lose that. And I think there's something to be said for people being together at least some of the time. I also think the idea, I think we all think like everyone can work remote and nothing would change. And, we're doing everything remote now. Like I go to church remotely with my family. We just do it at home. And that's how our church is set up. And I can watch a concert on TV, and I can watch a comedian on Netflix. And we all say it's the same thing, and it most certainly is not. Going to church isn't about praying, and going to the office isn't about working, and going to school isn't about learning. It's about worshiping and learning and working together. That's what it's about. And we're all losing something not being connected. So I think the idea that all this is going to be permanent is not true. I think that we're looking at a lot of, big tech companies saying, oh, we're going to work from home. Well, yeah, you're a big tech company. That's a little bit different if you're running a trillion-dollar enterprise with 500 employees, sure, and you're in a market with it's extremely expensive to live in and a talent shortage, that's a way to induce new people in. But I think most businesses are going to have some kind of hybrid to allow for that connectedness that people want and the collaboration that the end client is going to benefit from. And so that's where my head is at when it comes to all of that. We're pulling it off great. I couldn't be prouder of our team. Do I want everybody at home all the time? Absolutely not. Some kind of hybrid in the future, perhaps.
Yeah, you bring up some good points, and you hit upon the one area that's been most challenged during remote work, and we brought it up a little bit briefly in our pre-discussion, and that is creativity, ideas, collisions, the water cooler effect, exactly what you just noted. Now, arguably, via on Zoom and other platforms, could that adapt? It could. It's hard to imagine how we're wired, which is what, for many, many thousands of years, that's just going to change. On the other hand, I may push back a little bit, and my business is totally different. We've now become far more digital. I'm relatively lean. I'm much smaller as an organization relative than you are. For me and for others, there have been some tremendous advantages. Do we really need all the real estate that we have? Now, there's been employees that have adapted very, very well. And I think we as employers need to somewhat adapt to them as well. It may not feel classically 9 to 5 or 9 to 6. And perhaps that gives them a certain freedom that they now enjoy, but they're willing to sacrifice something else from a business or an employer perspective to make up for it. I suppose what I could also argue is for the employer. Now, you brought up a good example with the tech companies in the Bay Area. Real estate is so expensive, not just corporate, but for people that don't make even hundreds of thousands of dollars to live there. So commuting is a chore, and too much of a percentage of their income going towards rent or home ownership and mortgages is challenged. In theory, this now opens up in white collar industries, admittingly. It opens up the opportunity for an employer to have a global remote workforce that may be people that are incredibly talented, but that choose to live anywhere they want to live. Now, that also works both ways. That works also to the advantage of the employee that is better than average, that is talented. I give the hedge fund example. I'm in Greenwich, Connecticut. You don't need to be in New York City or Greenwich to be a hedge fund manager or, let's say, an analyst. If I am talented and I wanted to move to the woods of Wyoming, I could, as long as I have an internet connection, and that's going to allow me to be happier and my cost of living will be much less. Maybe you could even pay me less money, although they're going to cringe when I say that. What have you seen as an advantage to adapting in a more remote workforce in the world of financial services?
Don't get me wrong. I mean, I agree with everything you said. I just don't think the idea of the office is dead. People tend to swing from one extreme to another. I think creative, more than any large multifamily office or RIA in the country, has been more remote, I think, than probably any of the top 50. The majority of our wealth managers have never had an office. They work from home from the day they got hired at Creative Planning through today. And we have people that have relationships that oversee $500 million, and they're working out of their house. And they go to the client's office or the client's house or meet at a mutual location when the client wants to do that. The rest has been online or via the phone going back 15 years. So that's the norm at Creative Planning for the typical advisor. The minority work in offices. But you have teams of specialists that part of the interaction with the client is availability to do client service or to do trading, and having someone you can roll your chair back and ask a question. I think there's something to be said for a lot of that. And I see that more going to the hybrid type role. But I've always been a believer that real estate is overrated. People would rather have flexibility. And as long as you've got good people that are going to, and you're aligned with those people, they're going to do the right things.
And in terms of, it's a unique business, the world of a highly successful RIA and MFO having, I'm assuming, because you manage 50 billion, you have a fair number of employees. In terms of leadership, you probably have relatively, in this industry, very, very little what I would call middle management. Either you're a producer who's providing value as a rainmaker or as an intellectual on something on the estate planning, tax, or investing side, and to some degree servicing side, and that's really it. So you're, as the CEO, acting as the true leader, which is what? It's the capacity to serve and the ability to inspire. Have you found that your ability to lead in these more remote times is more challenged, and have you adapted to it?
Well, I think actually, like at times like this, really kind of accentuate, kind of like alcohol or money accentuates your personality. You can talk about how strong your ship is all day long. Eventually, you want the storm, so you can prove it, right? So I think that the team here, they probably feel better about themselves and what they're doing than they did before the crisis started, because they know that all the things we say we can do and we can deliver for people, we've been able to do it. And that's the same thing on my end. It gives me, I've got great people that have entrusted, their careers and their career paths at creative planning, who, support their families from creative planning and came here because they wanted to be able to do all the right things for their clients. And it gave me an opportunity to show them that no matter what happens, I'm going to stand beside them through this. Doesn't matter how long it goes, doesn't matter how deep the hit is, that we're going to be there for them. And so I view it as an opportunity to do that.
And in terms of, leadership leads in the culture. It's a combination of what you do, which are behaviors and actions that help define a culture. You've been so incredibly successful. How many MFOs could say we're 50 billion or larger? It's like really, really few. What is it unique about the culture that you created at Creative Planning? And I'm assuming it's probably adapted a little bit over the years, let alone the last 3 or 4 months with COVID.
Well, I think one of it is that we really tried to be a real family office that's very, very competence driven. So everyone says integrity, service, that of course that's a baseline, everyone has to have that. But we just value competence greatly. And the higher net worth a client goes, the more they're seeking competence, the more they go through all the noise of what everyone's talking about and pitching them, and they're looking for competence. And I think if you look at the top 50 RIAs, I suspect, and I've seen some independent research, that we've got more certified financial planners than any of them. We probably employ more estate attorneys than any of them. We have a very large tax team. So we're just very, very committed to education, designations, experience, and competence. That's the backbone of the firm, is delivering real value to the client. And that from top to bottom is what the firm does. It's a very player coach environment. Even the few leaders we have, they're still seeing and interacting with clients. I'm an estate attorney and certified financial planner. I still see clients. It's my favorite part of my job. And so it's a very action-oriented firm, combined with the competence that you would get in a very, very high net worth, very small family office. And I think that's been the combination that's really helped us connect with our clients and prospective clients.
What's the governance at Creative Planning? If I define governance most simply as how decisions are made, is it yourself? Is it a board? Is it a team, committee, consensus, majority?
Depends on the decision. So for example, if we're evaluating a certain investment, there's an investment policy committee that has 15, 20 people on it, and it will make the decision on what's going to get through or not get through. If it's involving the technology stack, it's going to go through a group that's led by our COO and then the head of the group it relates to, whether it's trading or operations or client service, and it would involve everyone that's going to touch. So for example, if we were changing our the way that we handle trade orders, we would have everyone from wealth managers and planners to the traders and the technology people all in the room together, and they would make the decisions. And so we're basically saying, what's the quickest way we can make a good decision with the right people at the table? And there should be nobody in the room that is not necessary. So we try to keep the groups as small as possible and try not to have a meeting culture. All the meetings we need to have and not a single one more.
Does Creative Planning, as an offshoot of governance, look to develop what some would call values, mission, and vision statements and policies?
Yeah, we have something that we share with everybody when they're coming on. It's a whole culture deck, and just whole presentation on what is the DNA of creative planning, what were the traits we saw in you to hire you, what are our expectations of you. When we're doing your performance review and we're asking, do you fit at creative? We're comparing you to this from a cultural perspective to our expectations. I think that's a very, very big piece to this. I think if you look, I've had an employee or two that were terrible, and the amount of damage, that somebody who's incompetent or malicious or arrogant, the amount of damage one person can do is pretty substantial. So we're really big on trying to keep that person out. And if they don't fit, if we've made a mistake, getting them out as quickly as possible, because there's so many positive people with that are so bright and work so well together. We don't want to interfere with that. We don't want to interfere with that culture that we're very proud of. And so we're very, very quick to take action on problems within it.
That's really very much a good thing. And my audience has heard me before recommend Adam Grant's book, Give and Take. I mean, simplifying it, obviously, you would rather hire givers than takers, but sometimes that's a little harder in identifying than even pre-employee testing allows. But when you make a mistake, correcting it very, very quickly is important. It's even more important in a tiny single family office that is often 3 or 10 people,
Yes.
because you just can't hide. In an office where there may be 100 or 200, you might be able to have 1 or 2 bad apples, but they produce or they add value. What we recommend to single family offices, you may need that person who's so-called as a taker, but they're going to bring down culture morale, but you hire them as simply not an employee. They're used on project specific. They're away from the office, but they're a great talent on something with estate planning or tax, but they're a horrible person. But you still may need their talent. So they're outsourced and strategically managed that way until you find someone who's greatly talented and a great person too.
One of my mistakes was to try to accommodate that or segment that out. And, if I had one do-over in my life at Career Creative, it would be to kick that out on the curb much, much faster. I think that, to me, everyone is going to look, whoever the least competent person is, whoever the least cultural fit person is, everyone knows who that is, right? And so to me, you're not where you need to be until you ask somebody that question and they can't answer it. If you can say who's the least, competent wealth manager in the headquarters of creative planning, and everyone goes, well, it's this person, that's not good. If everyone has to think about it for a while, then you've done a good job, eliminate. If you who's the biggest lack of cultural fit in the firm, and everyone knows who that is, that person shouldn't be at the firm. It doesn't matter if there's 3 people or 300 people.
Very, very true. I have my type of what Tim Ferriss would call his morning routine question. No, I'm not going to ask you what you had for breakfast, Peter. Don't worry. Of course, like everyone else, you're probably intermittent fasting and don't do breakfast. But I am going to ask you my version of that, and some of the consulting and project work that I do with single family offices is it often comes down, and we could argue the sequence. So I do want to hear your sequence. So you have to listen. Number 1 by far is people. I'm going to put ideas too, but technically it's people that come up with ideas. So you could bundle them together if you want. So people, ideas, technology, and systems. Lately, systems has been going more towards the top of the food chain for me. And I define that as standards, policy, and procedures, especially in today's COVID world. If someone goes down, could someone else pick up the slack? Do they have policy and procedures that are structured and organized for them to follow? Would you have anything you would take away, add, or what would your sequence be?
Well, I think it's people, but I think it's people by an extremely wide margin. I'm a very process-oriented person. I think that's a big part of the equation. But I think people in our industry is very underrated. And I would equate it to like college basketball. So most college basketball games, it's done after the class has been recruited, right? You could predict the wins and losses. There's going to be some exceptions there. But when Duke gets on the court and they're playing against their typical pre-conference opponent, you could put me on the bench, right? And they're going to win the game because the people, the talent is so overwhelming that the process doesn't matter as much. The coaching doesn't matter as much. Now, when you compete at the very, very highest level, they got to go play North Carolina and they've got to go play Kansas and Kentucky and all of that. Okay, yeah. Now coaching matters and process matters and all of that. But recruiting sets most of it. So before you get to the game's usually over. And so the people people is the biggest part to win. To win all the time, then you need everything that you just laid out, right? You need people and process, everything else. But if you give me A+ technology and A+ process and A+ product and C people, you're just not going to get where you need to be. It's not going to happen. You're just not going to be able to compete in this industry for sure.
Yes, and that certainly applies to single family offices as well. And yeah, there are some industries where the technology or systems may be a little more towards the top or maybe at the top. I don't quite know what they are, but I'm sure they're out there. But people, until one day far in the future, is for sure still number one, which is why it's so important of hiring the right people. And when you have the wrong people, kind of letting them go, like you said, sooner rather than later. That being said, with the advent of COVID-19, communication, project management has been all challenged. Have you made upgrades to technology? Does your team communicate by Slack? Do you use project management resources like Asana or Trello? How are they adapting in today's more tech-savvy world?
We've had all these systems in place before, from Team Chat and Zoom and our CRM through Salesforce, that nothing changed. We're just continuing on with the same tech plan that we've always had. And we had made a decision 18 months ago that we really wanted to double in size and attract more of that 25 million and up client. And to do that, we had made a big investment in technology and people. And so that was already implemented just coincidentally before all of this started.
And changing directions, but we're going to circle back to people and millennials in a second. But you got me going on your college basketball analogy. I'm actually working on an analogy for my masterclass, which is a PowerPoint centric on creating a family office. And I talk a little bit, so my international audience will have no idea what we're going to be talking about now. It's college football. So if you're playing a wishbone offense from the 1970s, and now it's a spread offense, you are just caught off guard, and I would think you're going to get crushed. What I'm going to relate the question to, I mean, I'm in my mid-50s. So with age brings hopefully good experience, a cool and calming hand, but how do I be careful about not getting, I don't know what the word is, becoming dated too quickly? How do I learn how to still have a beginner's mindset and how to adapt? Because it's a different ball game that we're playing now than was played even 4 months ago, let alone 2 or 5 years ago.
Yeah, I think I'm constantly in every space. Every couple of years, the leaders change, and everything that you need to get from here to there changes. So creative planning from 0 to 500 million had to be different. From there to 5 billion, there to 25. Here to you can never just take what you got from one point to another and sit on it. And I think that's why you see not just most family offices or most independent firms, but also most businesses just stop. And sometimes that's okay. And it's because not everyone's goal is not necessarily to be the very, very best and give a career path to everybody and all that stuff. Some people's goal is, I'm here to really just serve one family really well, or 3 families really well, and I'm going to make a good living, and I want to, they want a good lifestyle, and I want a good lifestyle. If those are your objectives, then all you have to do is meet those objectives. If you have a big team and you want to provide growth opportunities to those teams, you have no choice. You always have to be focused on how am I at the very, very top of this space, because it's just too competitive. Otherwise, you'll lose the talent, you'll lose the clients, you'll lose the advisors. You have to constantly reinvent yourself and say, what can I do? Also, like, what can I do now that I couldn't do before? Like, for example, at Creative Planning, we wanted to offer alternative investments from what we consider to be the top 1% of firms that would offer it. Well, when we were 5 or 10 billion, anybody in private equity would have, that's mid-size, would have let us work with them. But when we would go call what we thought was the top firm in the country, they weren't going to work with us. Well, now everyone will work with us that we've reached out to and tried to collaborate with. And I think that that's different. You want to take advantage of opportunities that present themselves to improve things and just constantly move up the chain until there's no one in front of you.
Very good points. Let's talk a little bit. If people are the most important aspect of the ones that I described, and I agree by a wide margin, the financial planning industry tends to skew to being a little bit older. And again, that brings experience, a cool and calming hand. You've seen it all before. But you also need to attract millennials, and not just those that are older millennials, but even those that are the under 30 millennials and the people in college now graduating, the Gen Z crowd. And some of them are taking financial planning at multiple universities where you can now do that. How are you attracting a younger millennial and dynamic audience? And then I'm going to ask you how you're training them during COVID. But why don't we start with part one?
So we've never had a problem attracting talent ever since we became, say, a $5 billion firm that was growing fast. And the reason is, if you look at the industry, we all know that about 90% of advisors are brokers, right? So they're selling products. They might own their own products. They might get commissions on some products. Well, there are a lot of people, particularly the credentialed people, that they're kind of supporting the guy golfing all day or the woman networking at the country club. There's that certified financial planner, the estate attorney, or the CPA that's in that family office or in that RIA that is actually doing everything. That person's attracted to creative planning, and they're attracted to creative planning because they get the independence. But when you go over to the independent world, 90% of the firms are small. They're not stable. They don't offer a lot of career growth. They can't offer best in class to the clients. They can't really be a family office to clients. So we're that nice combination of independent but large and growing, where you can use one hand and cover the firms in that space, and none of them grow organically at the rate that we do. So given that we employ 1/10,000th of 1% of people in the industry, and we are sitting nicely in that quadrant, we've just never had a problem with talent acquisition.
Yeah, I mean, you guys have a tremendous reputation for that. A bit of a sensitive topic. We've all seen in the last couple of months greater awareness to cultural diversity. I could look at the industry broadly and say it could probably do a better job. What are you doing for more African Americans, for more women in a position of management and leadership, to more diversity in general, which would add to the culture and the long-term prospects of an organization still significantly looking to grow?
Yeah, I mean, the industry is a mess. We have probably 15 to 20 African Americans, and then substantially more when you include all people of color at creative planning, which is actually probably more than, say, the other top 20 firms. Someone had just put out something on this, and it was kind of staggering, the lack of it. But that's still like nowhere near enough. And so we're doing a couple of things. One, we've always in the community really focused on breaking the cycle of poverty and trying to help people out of that. Our headquarters is in a fairly segregated city, Kansas City, and all of the major things that creative planning has done from 2004, from the beginning to now, have 100% been focused on that community. So we have built a center that distributes basic needs to give people products they can't get from food stamps, like soap and shampoo and all that, so kids could have it at school. People could get it while they were working at jobs or trying to get jobs. We delivered 750 meals to a housing project, which is unfortunately in Kansas City almost entirely African American, and we did $1 million donation to Harvesters to cover food for kids that were losing it from school because of coronavirus. Yeah. What we've added that's new since all of this started is we're working to Vince Clark, who heads this initiative within creative planning, is helping me build out a financial literacy center in the urban core in Kansas City, where we're going to staff that, and we're going to offer free legal, tax, and investment and planning advice to young kids, teenagers, and business owners in that community, and provide them free legal, tax, and so on. And we've moved our recruiting from just schools near us or the very high-end schools in the country to going out of our way to find students in these CFP programs that are from schools that are more African American. So for example, we do a lot of recruiting at the University of Kansas, which is an hour from us, but now we're going to go to maybe more to the University of Missouri or Florida, where we're more likely to encounter more diversity. So just trying to be more intentional about it. I'm proud of what we've always done historically. I don't think like we woke up here and just said, oh my goodness, what's happening? I think we've gotten that from the beginning, and we've done as an organization a lot to try to help that community in particular from our inception to today, but we needed to do more, and we are doing more.
In terms of during COVID-19 and even more remote work, I guess there is challenges to cybersecurity issues. What has your firm done at your scale? You probably have an internal CTO, a chief technology officer.
Yeah, we have a CTO. We have a 20-person team. I couldn't explain if you, no matter what you gave me time-wise, I would never be able to tell you what we're doing. I just know, I just know that they are very aware of everything that needs to be done, and that we have an independent audit of it as well. So we bring in an independent auditor to check how we're doing from a compliance perspective in that regard too. I consider that to be the biggest threat to our industry, and it's one of the very, very few things that I think a lot about and get concerned about. That's an area that we are very committed to talent and resources.
I would say so, not just having a CTO, but having 20 people. How many employees overall in the firm?
So within creative planning that we would consider the family office, there's about 600.
Okay, but 20 is a good number, and that's a cost center, and I mean that respectfully.
No,
but that's they're not
trust me,
rainmakers.
I know. Yes, I agree. I agree. But to give you an idea, I think it was just maybe 3 years ago we had zero. I mean, it just shows how much things have had to change in recent years. To, as we talked about earlier, reinventing yourself to go to the next level.
So although my audience is going to be more familiar with our work more exclusively in the single family office community, and there's going to be absolutely parts of our discussion that cross over, but one question that I guess could be a little more specific to you and your industry is your incredible growth from organically through strategic purchases as well. There's a belief that in the RIA and MFO community that scale will matter to drive down expenses, to have more diversity of talent, to have the level of cybersecurity protocol to have access to certain alternatives that you noted that if you were even a good size $5 or $10 billion shop, you may not have access to. So your role as the CEO, I'm assuming it still is pretty feverishly looking also at growth and expansion.
Yeah, I mean, I think like when we work with family offices, so we also will work with other family offices. For example, we have an extremely high net worth client. He has his own family office, but they delegate the investments to us. And sometimes we're delegated legal and investments. And we, because I'm sure your listeners know, you've seen one family office, right? That they're all different. And so we're able to plug in and do a part of what an existing family office may want. Now within the RIA space, unlike the family office where, you can have a family office just serve one family, and then you can partner with other family office to get access to certain investments, or you can plug in a place like creative planning to outsource the investment function or whatever function you want. When you get over to the RIA space, the independent advisor space, scale completely matters. That gives you different access to investments, different access to talent, gives you backup talent that wants to grow. It allows you to build out the breadth and depth you need to serve affluent families. This idea of the $500 million firm is dead. The question is, when is it going to get buried? It might be 3 years from now. It might be 9 years from now, but it's just not going to exist down the road. I think that you've got a bunch of market forces that are pushing that. One is it's just getting more competitive. You have to deliver more value to a client than ever before. In the future, I think we're going to see fees come down. I hope that creative planning, can get big enough to lead the way in that space. I also think that the SEC doesn't like regulating thousands of firms, and is going to continue to make it more and more burdensome for a smaller firm to operate, to force them to merge into a higher firm. For the SEC, you'd much rather regulate 1,000 or 2,000 firms than tens of thousands of firms. I think the custodians that these firms use are sick of dealing with all of these little firms. There used to be Scottrade and E-Trade and Schwab and Fidelity and all these. Well, they're all getting bought up now. You've got basically Fidelity and Schwab, and now there's Pershing's out there. But they're going to start to, I think, force firms higher by charging the smaller firms fees. Now, this is just all speculation on my part. I'm wrong about a lot of things a lot of the time. I feel pretty good that I could be right about this. And so I think when we look 10 years down the road, there's going to be some very big players that people trust. And, going to a firm that manages $500 million is going to be like going to a doctor who's by himself, and you're just hoping he's got the best equipment and he's got somehow going to figure it all out. You'd much rather go to the best hospital in the region, and there'll be a couple of them, and that's it.
And in terms of client interaction, which I'm assuming has been somewhat adapted since COVID, proactively reaching out to people, especially leading into March 23rd when the stock market was just going down and down. Communication really is a medicine for a lot of ills. Even if it's uncomfortable, what you're discussing and communicating, I'm not going to quite say the word that you demand, but kind of, what did you recommend that your advisors, how they reach out to people during the challenges of COVID, people losing their job, the stock market going crazy, et cetera?
Well, I mean, we inundated our clients with education and information. I mean, when the CARES Act was being signed into law, we sent them a video on what it meant for individuals, what it meant for business owners. When the tax policy changed, we developed a team led by our tax team and our tax attorney and estate attorneys and planners that people could reach out to that team for help. We helped with the loans that people needed to get. We sent, normally we send a letter every month or two. We probably sent a dozen in 2 months. We did extra podcasts. I did videos from home. And all of our advisors called their clients and responded to every client the same day they called. Communication, 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 communication. You have to communicate, you have to educate to empower people to know where they stand. And if they're educated, they're going to not make the mistakes that most people make. Fidelity released a study, or Wall Street Journal did an article on Fidelity's research on their cases that most of their clients went partially or all to cash, especially the older folks. Well, that didn't happen at Creative Planning. I mean, 99% of people just kept doing what we asked them to do, and they came out way ahead because we were big buyers in March, but we had to educate and communicate that. And so, I think that's one of the big advantage family offices have is, all the people that are listening to you that are running family offices, it's so high touch that their family knows why they own what they own. They know the time horizons, not 3 months or even 3 years, but that most of these investments are 10 years and 20 years, and that things like this, they're not precisely the same cause, but they happen. And I'm sure if you did the same study Fidelity did on their book, if family offices did it, I'm sure the vast, vast majority didn't panic at all and maybe even took advantage of some of the opportunities that presented themselves. So there's a big advantage of being a family office.
I'm going to have some investing in trust and tax questions shortly. I do see a couple of questions have popped in from our live audience today. I'm going to read one of them. I think we covered it pretty well, but if you want to put a bit of a bow on it, the question is, other than working from home, what changes will take place in the asset management industry due to this pandemic? Do you see client acquisition that is going to be completely electronic, meaning no and never an in-person meeting?
So I'm a hard no on that everything moves electronic, especially, wealthier people actually want to sit down and meet somebody before they take everything they've ever worked for their entire life and hand it to somebody. And so I think, younger people that were doing it anyway, it's accelerating that. Do I see, the average 63-year-old signing up with, $17 million or even $1.7 million online? Some of them will, but I don't think the market's like completely moving towards everyone completely embracing that. I do think it accelerated consolidation in this space. I think for the last 12 years, if you owned a firm, you just said, well, I'll wait another quarter and my revenue will be higher and I'll get more for my business. And you could say that every quarter for dozens of quarters. And I think now people said, wait a second, in 6 weeks, the value of my firm went from $5 million to $0 million. And so now that the market's recovered, you're seeing a lot of those folks go, you know what, I'm getting out of here because another year or two, if there's another bear market, I might be stuck in a 3-year cycle and working a lot longer than I anticipated. So it's accelerating the consolidation you see. And accelerated consolidation is going to result in much, much more competitive, accelerates the path towards the smaller firms not being able to exist.
How has the COVID-19 impacted your industry as something you're doing internally because it potentially makes sense, or kind of a threat more so to smaller clients? And that would be the rise and a little bit of the stagnation of the so-called Robo Advisor.
Yeah. Well, I think Robo Advisors have been an epic failure. I mean, I think if you look at them when they came online, everyone said, oh, everyone's going to go there. No one went there. Very few people went there. For the hundreds of millions of dollars invested in those places, they manage $5 billion or $8 billion or whatever, and they had to reinvent themselves to do it. They had to start doing alternative investments and start white labeling their product for RIAs. Now you go over to Vanguard, different story. Vanguard, I don't consider a robo advisor. I kind of, instead of viewing it as cheap wealth management, I view it as expensive selection of Vanguard funds. You go to Vanguard and you pay 30 basis points and they put you in 4 Vanguard funds, which they used to do pretty much for free. So I think that that's also a different world. I don't see any of your family office folks, heading that route either. What you don't really see is a real robo wealth management offering that even competes a little bit with a typical independent wealth manager. And that's saying something, because the typical independent wealth manager doesn't offer a lot of value. You really have to get to family offices or some very unique wealth management firms or bigger wealth management firms that have proven out some kind of value to their clients. And so this whole idea that people are just going to move online hasn't worked. And you're seeing these places, they're having to sell to other places or merge with other places to survive.
And in terms of investing, do you start a foundation? I mean, obviously you want to get information from the client, but do you do an investment policy statement? Do you stick to only strategic or sometimes tactical asset allocation? Is it customized, but are there some general best practices given the scale of your firm?
So we probably have, I think, we got the number right, over 30,000 unique portfolios. Gives you an idea of just how customized things are. Dozens of people that do nothing but trade full-time at creative planning. But I think the way to think about it is, let's say we have a client and they've got $5 million and we want them to have some private equity, private lending, private real estate. The wealth manager doesn't just go, networking and figure out which ones to buy. The investment policy committee or the leadership team, myself and the chief investment officer, we're figuring out, what do we see in this space? Who do we think the best is at mid-market lending? Or who are some of the top players? Who do you think some of the top players are with life settlements or private equity or whatever? We go seek out those relationships, try to negotiate fees, try to get a reduced minimum. And then for clients that it's appropriate for, we'll recommend it. Some of those clients will accept it, some won't. And then, of course, a private equity fund opens and closes. So a guy who signs up 3 months later winds up in a different private equity fund. So you could have, if you had 100 people at creative planning with $5 million, you probably have 99 different portfolios, because we're working around the positions they're bringing to the table. Some want alternatives, some don't. Some want bonds, some don't. Some are some have more short-term needs than others. Some already have real estate that they own, private real estate or private businesses. So we remove those kinds of things from their portfolios. And then, you've got the timing of all these different types of alternatives that are available to them. So it's really managing each of them a little bit differently, but using a philosophy to manage them, which is, we believe managers matter in the alternative space. We believe costs and taxes manage in the publicly traded space, and having the philosophy be the screen of how the client's money is managed.
Yeah, I mean, you bring up a whole slew of follow-up and questions, I guess, relative to that. You hinted at some of them earlier. If you have someone who's traditionally wealthy, but heading to retirement in 2 years, yeah, there's probably some concern relative to the stock market bottoming out on October 23rd, bouncing back, arguably less so from logic. I mean, this is a once in a lifetime for now pandemic. You have unemployment like we've never seen in what, like 80 years since the Great Depression. And I think you have multiple small business owners that will just never bounce back. It sounds really bleak, but it is a presidential election year. There's reasons to pump money into the economy, into unemployment, to make people feel a little better. Arguably, we're kicking the can down in the future relative to just an incredibly burdensome deficit and tax rate. But oh well, we'll worry about that at some point in the future, versus someone who's incredibly wealthy relative to what their expenditures are. So it's all relative. But like you said, they might have no problem, 10, 20 years, a generation on their side. So how you would handle that is going to be different depending on their circumstance.
That's right. So I met a person, he's a multi-billionaire in California and runs probably one of the top 50 companies in America. He wants all venture capital because, quote, everything else is boring and I don't care if I lose all this money. I already have, so you've got, that's a totally different, he'd be invested completely different than somebody else in the Southeast who's, also on the Forbes list, who's, trying to move up on the, is very motivated by different things. And so I think different people take very, very different approaches to what it means. When you're financially independent, which is what, most of your listeners are running family offices and they're working for families that are financially independent, the goals become very, very diverse. I mean, some people want this thing to go for generations. Some people just having fun, and then it's all going to foundation when they die. Some want it to go one generation. Some people want to start businesses. Some don't care about that. They don't want to worry about stuff. They don't want to deal with complexity. And I think that, when we plug into family offices, just watching them drift and change over time, one of the biggest problems that I see is that when you drift, you really can't self-correct, because so much of what family offices are doing is illiquid and have very long time horizons. And so as a family might want going one path and then want to simplify their life, it could take the generation to get back to simplifying it. And so I think that family office, having very thoughtful people internally of really having clarity around what the family wants and how do I give it to them. We have an ultra affluent practice at Creative that works with our wealthiest clients. And that's really, more than anything else, is just trying to help them divide clarity of what do you really want. I mean, are you willing to deal with 150 K1s and a 5-person staff so that you can maybe earn 2% more a year? Or are you good with kind of the relative certainty that comes from low-cost diversified public trading, and maybe you'll earn 2% less, but it's going to be super easy and to know where you stand all the time and all of that. And you get very different answers than you would expect when you just really start to simplify things in terms of, is it going to charity, kids, how much has to go to the kids? Do you care if your kids get 50 million instead of 55 million? Are you willing to do A, B, C, and D so they get 55 instead of 50? Framing it in a way where you can give real life examples and help them make the right decisions. I think a lot of affluent people, everyone assumes that they want to just have more in a risk adjusted way. And that's not what I've really found. I think that if you really explain complexity versus the complexity you have to do to get more, many of them are not willing to do it. I personally am not willing to do it. I'm not willing to trade complexity to do a little bit better. And I've kind of seen it all. And if anything, I've learned from working with family offices and the ultra affluent, and I still work with them myself. I travel 1 day a week and sit down with somebody. Last week I was in Mississippi, and I was meeting with somebody who had over $100 million. And, I'm doing that every week. I'm sitting down with a high net worth person in some state somewhere. And I have consciously over time said, you know what? Complexity is generally not positive. It's not positive for me. It's not positive for beneficiaries. The trade-off for the little bit potential of more net worth is not worth it. And so I've really, really spent a lot of time trying to help families clarify and simplify things. Be as complicated as you need to be, but no more complicated than that. On the you've quoted Tim Ferriss a couple of times. When I was on his podcast, one of the things he really clung to that I said was, what have you observed with these ultra families? I said, they spend their lives adding one thing after another, and then they get to a point and this light goes off. And sometimes it's they're 55, sometimes they're 75, whatever. And then they try to undo everything. They're trying to undo all the stuff that they've added all their life. And so it's just,
For sure.
No one that's just like, this is perfect. It's add. Holy, what am I dealing with here? How do I simplify this craziness? And then subtract. So the sooner an advisor to those ultra affluent folks, whether it's creative planning or some of your listeners that advise those folks to family offices, can help them identify that, I think that's one of the greatest benefits you can give a family.
Wow, that was amazing commentary. I completely concur. And they're all so different. They're all snowflakes. You gave the example of a multi-billionaire that wants to be hyper aggressive in venture capital, and either it's bust or it goes up 20 times. Now, again, I'm sure they got a little bit of cash reserve, a little bit relative for them, but that's how they think. But the outside world often thinks, let's use a clean, even number. Someone's a billionaire. Yeah, you're correct. They could be all in cash, have strategic tax mitigation, asset protection, and estate planning. And in theory, unless something really goes wrong, they should have money for generation after generation after generation. And yes, that is true. That's going to apply to some people, but a lot of them, like your person in venture capital, They just can't help it. They're human. They're competitive. They see what others are doing. They looked at deals they missed out on that went up 1,000 times, and it bothers them. They just feel like they need to be active. On the other hand, exactly what you said, wealth creators, as they often age, will say, I've gotten too complicated. And I'm already rich. It's going to last for generations. What am I doing to maybe squeeze out an extra 100 or 200 basis points? I'm better off focusing on being happy, on having better family harmony. That's going to be more valuable to my families generationally than looking to ek out, well, we're an LP in 112 different funds. That's a hell of a lot of work.
We're joking, but that's really, I think, the number one problem for all the ultra affluent is that you add all this complexity and it creates a disconnect between the family and their wealth, and it creates confusion and all these things that keep people from wanting to get engaged and empowered, and it causes more harm than good, in my experience, most of the time.
For sure. That being said, substantial families are often going to be active in alternative investments. I'm way simplifying it, and it relates to what you just said. They could either be a direct investor, which unless they have a lot of money and they have an internal team of people that they're paying a lot of money for that have experience in that probably isn't going to be the most strategic move for them. If they deem it applicable to be active in alternatives, they're probably going to be allocating through third-party managers. But third-party managers, big VCs are very, very hard to get into, even for billion-dollar families. You got 50 billion, it's a little different. So you're going to have certain access that even they don't have. And that is a way for families to potentially also work with a company like Creative Planning for access to even deals, even they as a billion-dollar family, a top 600 global family, but still can't, quote unquote, get into. But you are going to see families that are going to look at alternatives. Now, then again, it's relative. Hedge funds, and I live in New York City, and it's an actively trading long-short manager. I'm getting crushed in taxes. Institutions don't have to worry about that, but as an individual, I do. And the net of it, net of taxes and fees, may not even be worth the headache and the aggregation I'm getting from being so active with so many different managers. That being said, you have a lot of great relationships with external managers. It is going to make, especially now with a dislocation in the private market, it's an opportunity in private equity potentially to jump on in. What are you doing with your wealthiest clients in terms of their activity in alternatives, and where are you seeing the trends going towards?
Well, I think they have a very mixed views on what to think of the alternative market right now. It's become much more popular. It's become more accessible as you move downstream. And so I think you have to be very, very selective about where you go, because and thankfully the first half of the year has diffused it a little bit, but valuations were getting very, very high across the board. There's a lot of money chasing the same things. I think now the thinking is, will the vintage year 2020 or 2021 be the new 2009, where you're getting in where it's a little better, and just observing the transactions, it looks like it might have gotten a little better, but not a lot better. The real crisis that we had just did not go on long enough to create a lot of bargains. And so I think people are being much more selective about the types of managers they get in bed with in the alternative space than they were years ago.
That's for sure. But like you noted earlier, again, a family may be $1 billion family. And I guess if you look at even net of taxes and fees, there may be a little bit of a spread they would get theoretically to be inactive in the alternative. No, they're not going to have any say in any matter. Their money's going to be tied up, and they really have to decide, is it going to be worth it for them? And for some, absolutely it is. But for many others that are looking, I have one family, about $1.5 billion liquid, and I'm simplifying it a little bit because they do some unique things with like 1% of that money. But for the most part, we're invested in 15 separate stocks, a couple of bonds, and some cash management, and that's it. I'm like, wow, like how am I doing? Our fees are incredibly low. We practically control our tax picture. And we think that now is tactical to be in the public markets because it's, according to them, easy to identify some of the winners in a challenging world like today. Amazon, Walmart, Google, etc. And yeah, right now that's looking like it probably is a pretty good strategy. We could debate whether that's way too concentrated for a very wealthy family, but you spoke about simplifying their life. Oh, they sure did.
Yeah. And, it probably is more diversified than it's. I bet the portfolio you just described is probably 70% correlated to the S&P 500. It's just
Probably.
having all of those big stocks. And so, these companies are so huge. You own Disney World, that's more diversified than buying getting into 10 or 20 LPs, because they're in 10 or 20 things that are bigger than those. And so I think that these big global American companies that are really global companies, they're deceptively diversified themselves.
For sure.
Amazon does a whole bunch of different things. Disney World does a whole bunch of different things. So to your point about the companies you own. And so owning one of those companies is probably more important than owning the 100 bottom companies in the S&P 500 in terms of really diversification in a 15 stock portfolio. So I think that, I would not go that concentrated, but it's not as concentrated as I think it sounds, given you're not picking 15 small caps, you're picking 15 global companies. But I do like the idea of families controlling their taxes and controlling their fees and having more control over their destiny.
And it's one of the things you see highly sophisticated single family offices do. Sure, investing is going to be a good part of it, but other things that you also focus on as an MFO, which most don't, or they don't have the internal people that you have, and that's the tax picture, the estate plan, and for the uber wealthy, and even those generally wealthy, concern about asset protection. So we look at that in the single family office world as being a pretty powerful 1, 2, 3 punch. And again, the family's already rich. They don't necessarily need, we need to get 100 points above a benchmark in investing. No, you don't. You probably want simplicity, liquidity, and you want to manage your tax, estate, and asset protection picture. It sounds like you're doing some similar things with your ultra high net worth group inside Creative Planning.
Yeah, that's right. So, for them, we're building a picture of what their visions and goals are. We're putting that in writing in a financial plan. We're then developing an estate plan for the legal structure of everything, which takes into account taxes. We then pick the investments. And then to the extent asset protection is needed, we have a legal team that will draft everything from LLCs and FLPs to foundations and trusts. We have a Nevada-based trust company that we're able to utilize for those that want to take another level. And then we obviously have a whole team dedicated to risk management, just not losing everything in an accident or something like that. So there's multiple layers to that: the legal and tax component, the asset protection from a trust component in Nevada, and then the risk management piece. But we try to cover all those bases because these families, their number one goal is to stay wealthy. And
For sure.
Their number two goal is to grow it.
Even when they think it's the other way around, it's really not.
It never is. No, it definitely is not. Yeah, to stay there is the number one goal.
I forgot that you guys have the Nevada Trust Company. That's become more trendy among uber successful families in terms of setting up effectively their own private trust company. Wyoming, Nevada, Rhode Island, South Dakota. We won't get into the complexities. Is it better to do it regulated or unregulated? So yes, we've covered that a fair amount with a variety of people inside a family office association, but I'm assuming not many multifamily offices have that level of breadth of services that you have. That's why you're one of the handful of biggest in the world.
I think that's part of it. Yeah, it goes back to exactly where you started. To kind of like a comedian, bring it back to the opening joke. You had talked about the importance of people. I put that at the top, but the next piece is what you said, is the ability to deliver. So it's just that we gave those people the tools. So you got the best. We try to develop the best. The best group of people and give them the best weapons to help a family succeed, and you get that combination, and that's been a big part of the success.
Yeah, it's funny that you mentioned that. Again, in some of the work I do with family offices, always mentioning, again, your people are going to be number one, but since they are number one, you might as well arm them with the right technologies, policy and procedures, systems, so they could spend more of their time on what's going to be most important to you and the creative part And I'm not saying to automate everything else, but to some degree, a little bit, that's what technology and systems do. And that allows the talented people their creative flexibility and freedom to really think outside the box and to make you as a wealthy family be resilient, and a word I steal all the time from Nassim Taleb, to be anti-fragile. uh, so do you even do things as a multifamily office like paying bills, helping families form family constitutions, do family retreats, anything like that?
Yeah, we do. So we have an entire bill pay team. We have an entire small business accounting team. And we're doing their legal and tax. We have family meetings where we go over the entire estate plan and financial plan and portfolio. So that's a very big part, particularly as you get higher net worth, of being able to deliver to those families. They want to see all of that put together in a way that speaks to the multiple generations. In a straightforward way with they want a limited amount of time, but to get it all delivered. And I think we do a nice job of that for them.
I think it's pretty obvious from what we discussed so far, but I'll ask you, for a single family office representing a singular family, usually a couple of $100 million and up, but arguably even at lesser amounts than that, how they could, even the biggest SFOs, which might even be 20, 30 billion huge, are still going to be nowhere near as big as what you have at 50 billion. How could they benefit from selectively outsourcing or using services from a company like Creative Planning? You kind of hinted at one of them, access to alternative managers that even a $1 billion family that wants to give them 100 million may not be enough money. So what are things you could help a single family office with?
Well, interestingly, I think the thing that we wind up getting the most is more of the publicly traded securities. And I think what happens is usually the family office, their client already had some alternatives or already is running some businesses. They're looking for a stock bond portfolio to complement it. The family office is really more into managing everything, managing managers. And so they'll hire us to handle the portfolio element and then often the estate planning element, like how does all of that tie together? I found that most of these family offices have very deeply entrenched tax relationships already, which is great, or they're doing it all in-house, which is great too. A couple have used us for trust services. So we really go where the family can use us where they want to use us. I think we get used the most on the portfolio side.
Putting you a little bit on the spot, you kind of gave us a little bit of a look for the future of the RIA and the MFO scaling up to be significantly in terms of size, but less of them. What do you think is going to be the future of the single family office?
I think you're going to see them begin to collaborate more with other, and you're just going to see more and more collaboration as the world continues to get, unfortunately, more complex. And it's just so hard to have access to all the information you need to in-house. So I think organizations like yours that bring them together to learn best practices from each other are going to thrive in this type of environment. The people that bring them all together in other ways are going to thrive because there's just too many. It's just becoming everything from tax to legal to charitable to investments. It seems that every 5 years, 10 years that goes by, it's more complex than it was before. And you really can't stay in your own little ecosystem and pull it all off. You're going to have to get together with others that are like you and try to develop circles that you trust and that are not going to be competitive, but more collaborative. So the families of both family offices benefit.
Yeah, I mean, my comment's going to be a little perhaps one-sided and hopefully not too much so, but how true. The challenge with a single family office is they tend to be very siloed.
Yeah.
In being siloed, you have blind spots, you perhaps lose a little bit of open-mindedness, and you're not having enough different resources that you know and trust for best practices and standards and ideas. And that's one of the problems with family offices, bringing someone who's incredibly talented internal, whatever, let's say an investment banker type or private equity professional. But if you're going to hand tie them and you're not going to give them enough activity, you would be better off outsourcing them, have them remain at a giant global institution where they have deeper resources than you'll ever have, and they're working with the more diverse group of families to add value. You don't need to bring everyone internal. That's it's one of the things that we've been talking about, and that is going to be the rise of what I call the virtual family office. And COVID-19 is thus accelerating that. as these dated family offices get more comfortable with technology and with more selective outsourcing. For those, Peter, that would like to be more familiar with your firm and reach out, especially in the single family office community, how could they do so?
So they can go to our website, creativeplanning.com. They can email in and you can talk to somebody on the ultra affluent team. You can email me directly at peter.mallouk, Mallouk, at creativeplanning.com. I'm also on Twitter, Facebook, LinkedIn under my name, Peter Mallouk, and you can follow me there as well.
That's fantastic. Peter, it's been a tremendous pleasure to have you on the show. Very much look forward to, I'm sure there'll be a next time. And kind of wrapping up a little bit of my close, it was really great to have Peter on. And again, even the biggest SFOs, they don't have 50 billion plus. And Peter's growing so quickly, that's going to be 60, 70, 80 billion, probably sooner rather than later. So the insights and best practices have been incredibly helpful, hopefully for my audience. Everyone, I'm Angelo Robles. I'm the host of Angelo Robles' Effective Family Office podcast on Stitcher, iHeart, Apple, Spotify, and other platforms. On YouTube, where some of our interviews, especially now more than ever, make it up. It simply is, I hope, a great name. It simply is Family Office. So Family Office or Family Office Channel, you'll be able to find it on YouTube. And I'm the founder and CEO at Family Office Association, a global membership organization dedicated to single family offices, doing a significant amount of original proprietary content, hosting global programming, which, yes, is on hold because of COVID. But like my members have said, I went from doing 12 events a year to theoretically doing about 200 because near every day I'm doing daily Zoom interviews for our members to interact and to hear cutting edge thought leaders like Peter and many others that we've had over the last couple of months. This has been a hyper creative period for me. You've heard me talk about my masterclass on creating a resilient, anti-fragile single family office. And some of my questions and principles I discussed with Peter are going to be part of that significant masterclass for my members. And I promise it will be ready by the summer. So it's not going to take until after Labor Day. I've been fine tuning it maybe a little too much, but we'll wrap that up and get that out there as a service sooner rather than later. I'm very active on social media, all the platforms, including Instagram. You could find me, website familyofficeassociation.com, and email angelo@familyofficeassociation.com. Thank you to our live audience, those that watch this on YouTube or those that hear it on a podcast, and special thank you to our special guest, Peter Mallouk. Peter, thank you so much.
Thank you, Angelo.
My pleasure.